And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. It is a confusing moment to be an investor. There's unusually high levels of uncertainty around inflation and the state of the economy. What should your asset allocation look like in the second half of the year? Let's talk to two industry veterans who both have their hands in the ETF business as well. Jason Trennert is chairman of Strategist Research Partners. Bruce Levine is the CEO of Nightshares and was formerly president of Wisdom Tree Investments. Now, Jason, you're one of the very best people I know at the 30,000-foot view of the world overall. Tell us where we are right now on stock prices and what side of the whole recession/soft landing debate do you come down on?
Well, as far as stock prices go, Bob, I think the good news is a good portion of the multiple compression, I think, is behind us due to expectations for higher inflation. The bad news is that I'm not sure we've seen the earnings adjustment that people are anticipating yet. Right now, if you look at S&P 500 operating earnings, they're still forecast to be up about 10% next year. We think that's going to be more like 4%. And that maybe leads me to the second part of your question, which is we're more in the soft landing camp right now. Although I have to say history is not really on our side on that. Generally speaking, it's very hard for the Fed to pull off a soft landing once inflation has gotten away from it.
And of course, that impacts the whole earnings outlook. If you're on a soft landing side, maybe you're going to get 4% increase in earnings instead of 10, as some people are expecting. But if you're in a recession side, we could be down 10%.
Yeah, earnings, in typical recessions, earnings fall about, reported earnings fall about 30%. So it does make a big difference. The good news is that you do have pretty tight labor markets. You still have a pretty easy Fed, and you still have a lot of excess savings in terms of consumers and corporations. So hard landing is hard to forecast right now, it seems to be, and we're going to give the Fed the benefit of the doubt for the time being.
You know, Bruce, you have been in the ETF business for a long, long time. I mean, many, many years, decades even longer than I have. And what's amazing to me is the resilience of the ETF structure. We've had a rotten year. The S&P's down 20%, and yet we still get inflows into plain vanilla ETFs overall. It's the resiliency of the structure that's amazing to me. You're a veteran. What do you see happening in the second half of the year in the ETF business?
Yeah, I think the ETF structure has always been the gold standard for innovation, and all the good ideas come out in the ETF structure. That's going to continue. The investors have spoken. They like the structure. And so, the markets, I sort of agree with Jason, they'll be kind of shaky for a little while. But when they respond, you'll see probably record flows in ETFs.
Yeah. I want to go back to you because you've gotten into the ETF business this year, which I find very interesting. That after all these years of being a big strategist, now you're getting back into the ETF business. You launched the Strategist Macro Thematic Opportunities ETF. This was launched in January. Actively managed, you're looking to outperform the broader market by providing exposure to multiple macro thematic. This is right up your alley. But tell me about what's the idea here.
So the idea, Bob, is that all of our clients are institutional investors. So we do written research, we visit them, but there is no ability for individual investors to access our work in any way. We thought this was a way to do that. We are very thematic in our approach, and the idea is that we're actively managing the themes. So we focus on what we think are the biggest drivers of stock prices at any given time, and do our own quantitative analysis to pick stocks to play those themes. So the themes now are, as you might suspect, higher inflation for longer, quantitative tightening. We want some cyclical defensives in the portfolio, and we also like the idea of deglobalization after COVID and after Russia invaded Ukraine. So all those things taken together, I think it gives us an interesting portfolio. Certainly pretty levered to commodities and oil prices, which worked out really well at the beginning. It hasn't worked out so great lately, but we're optimistic about the second half.
So when I look at the main holdings, we always want to look at what your top 5, 7, 8 holdings are. I see a lot of commodity names. I see Occidental. I see Nucor. I also see the dollar, the U.S. dollar.
Yeah.
What's the rationale
well,
here? I can understand why commodities, because all the macro guys are really into commodities right now still, but what's the dollar?
Yeah, well, the dollar really is
right about that.
We've been right, but listen, the dollar, it's hard to see another, certainly Bank of Japan or ECB are way behind the United States, and they're taking a big gamble, it seems to me, A weaker currency on their part helps their exports. But it provides real risk to their consumers. But the Bank of Japan and the ECB don't seem to be even in the ball game as far as trying to fight inflation, whereas the Fed, even though it's late, is fighting. It's clearly fighting inflation.
So their weak currencies are going to make imports very expensive for them.
Exactly. It's remarkable how strong commodities have been, even though they've weakened recently. It's amazing how strong commodities have been, despite the fact that the dollar has been as strong as it is. One wonders what commodity prices would be like if the dollar weakened.
And just as a tourist, I was just in France on vacation. I marvel it was $1.04 for the euro. It was $1.25. Not
you're kind of through the IPO
that's worth
price.
Buying a couple of glasses of rosé.
Yeah, you bet.
A few nice shirts overall. Bruce, you ran the ship at Wisdom Tree for a long time, but what's amazing is this new firm that you've got.
Yeah.
You've got a new business going here, and it's related to after-hours trading. Your firm, Nightshares, you've got this new firm. You launched 2 ETFs in the last 2 weeks. The Nightshares 500 ETF, the 2000 ETF. Both are seeking to capture this effect. You call it the night effect, which is a phenomenon whereby you say overnight markets generally outperform daytime trading sessions on a risk-adjusted basis. That's an important word, risk-adjusted basis. So explain how this works. Tell us what are you owning here, and what's the rationale for this?
I mean, the research that launched us was just incredible when I first saw it, just how persistent and powerful this effect was, that most of the return you were getting over time was coming in the night session. So the night session is I buy at the close and I sell the next morning at the open. And
it's that simple, though. You're not trading in between.
And then I'm sitting out the day.
You're buying at the open and selling every day on a daily basis.
And what the research showed that was phenomenal was how poorly rewarded and volatile and noisy the day session is. That was the thing that really struck us. So, for example, in the case of small caps, over many, many years, the daytime return is negative on the Russell 2000. So we have 2 funds, large cap and small cap, that are trying to, capture this effect for investors.
Now, let's assume that this is correct. I'm not disputing you, but I'm sure there's people who would dispute this. But why does this occur? Why does this effect actually happen?
Again,
assuming this is
there's some
correct?
academic literature, lots of it actually, and there's sort of a few reasons. One is news flow happens when markets are closed, whether that's earnings or M&A. M&A is very positive for the markets. Earnings on balance positive for the markets. So you have to be invested overnight to catch that. And then there's a lot of structural reasons, sort of de-risking that happens at the institutional level. People have this sort of desire to go home flat sometimes so they can sleep at night, and so they leave something on the table for the other investors.
Yeah. So I want to make clear we're buying at the start of the after-hours session. There's really 3 sessions in my mind. There's a pre-open that's 4 a.m. to in the morning that's out there. There is 4 to 8. There's a regular hours is 9:34. Then there's after hours, right? 4 to 8 p.m. Eastern time, right? Tell us where you're buying and selling.
So our goal, all our research was done this way, and it's the goal of the fund, is to get as close to the 9:30 New York open and the 4 p.m. New York close. So this morning, the fund, right around 9:30, got out of its position and it's sitting in cash. So, it took a hit overnight with the rest of the market, but it's now down less. For example, our fund NSPY is down less than SPY because the market continued lower today.
So when are you buying?
And so tonight at 4 o'clock, we'll go in and buy.
4 o'clock is when you buy. Okay.
And so we're sitting sort of in cash and treasuries throughout the day.
Jason, you have any thoughts on this? I mean, there are markets where it seems that there's an awful lot of activity. But in general, my overall experience with professional investors, they constantly come on and say, be careful about in the after hours. Liquidity is much thinner. The bid asks are much wider. So it would seem to me to be cautious. Now, he's making a very important distinction here. We're not trading. That's what his distinction is. But still, the academic literature is very interesting.
It is, and I would say it's somewhat counterintuitive, which makes the fund interesting, right? It makes it different. And I have to say, I know in certain asset classes like Bitcoin, but as an example, I think almost all the action is really after market hours. But it's very interesting to hear this academic literature, particularly regarding small caps and maybe even less liquid names than maybe the larger cap names, where there's probably a lot more that goes on that moves the stock, I would imagine.
Absolutely. I mean, this thing we call the night effect exists on individual stocks, lots of smaller ETFs, but we wanted to start with the large liquid indexes where we could use the futures market just to deliver it very efficiently.
Yeah. But this thing with the small caps, your contention is, we're talking about the Russell, right?
Russell 2000,
that overall it's a negative return during the day hours.
Yeah.
And
with a lot more volatility.
With more volatility, right. So you're even risk adjusted, of course, here.
Yeah.
And we still don't know why this effect actually happens. I mean, I'm trying to think of efficient market hypothesis here.
Yeah.
Why would this effect actually happen? Everything would smooth out in the long run, it would seem to me. But
it seems to be this sort of institutional de-risking, this desire to, one of the professors called it an illusion of control, right? If the markets are open, I can trade out of any position, but if they're closed, I'm sort of a dead duck waiting for the open. And so there's this sense of leaving things on the table.
Really?
Yeah.
Okay, so let me just, do you think there's a future doing this in an after hours? I mean, I had some people on who were seeking to start an exchange that want to operate 24 hours around the clock now. There's people seeking to do this. I know Robinhood at one point wanted to have what they call hyper-extended hours. I think in Robinhood you could trade until 6 p.m., but they want, at one point they were talking about it, about doing hyper-extended trading. Is this, do you see this as a trend that's happening?
Not exactly.
I mean, I know, in a sense you're agnostic, it doesn't matter to you, but if there was more trading activity, there would probably be less volatility. I'm wondering if more of this would smooth out.
It might smooth out, yeah, but until the New York Stock Exchange and the other venues really decide they're going to really extend and people's behavior changes and trading volumes shift dramatically. Once a day, the accountants have to come in and value everything and say this is what a fund is worth, and it's a lot of that sort of structural things that go on at the end of the day. Things get marked to market, interest gets charged on position, capital gets charged on positions, and that seems to be what causes the night effect. And so we don't see it going away, even if volumes ticked up a little bit in after hours.
This seems to be a phenomenon of the modern trading age in general. Everything is trading faster. There's more of it. We see, of course, in Bitcoin, in crypto as well. Electronification has made all of this possible. When I came down here in 1997, there were 4,000 guys. It was all guys, essentially, here, sitting here, right around us, that had 80% of the volume. All happened on the floor with a bunch of guys yelling at each other in 19. It's hard to believe in our lifetime. And now the floor has, I don't know, 15, 18% of the volume.
In the 70s, I believe they had to close the market twice a week during the paper crunch just to keep up with the back office. Right, so now with electronification, there's really it doesn't seem like there's many constraints in terms of trading.
Where did you come up with this idea? It's a curious, because looking at it, to me, it's always been, thinner trading, higher volatility, it seemed to me, wider bid-ask, kind of risky for people to trade. But you've seemed to have made an observation that, well, independent of all that, the market actually does this.
Yeah, so we have a sister company called AlphaTray, and they have a great research team. They were running a hedge fund, and they were using this signal in the hedge fund. And we just kept looking at it, and they kept showing me more and more how, and it was one of the most compelling signals they had. And so I got excited about it. I realized no one had ever done this in ETFs. And then after that, I found all this other academic literature that was supporting it. And so that really kind of sealed the deal that said, wow, there's something here. And then the question was just, can we deliver it? So, can you trade through it? And the markets have changed a lot since the paper-based you were talking about. It's much cheaper to trade. We have a lot of different instruments available to us, so we got comfortable we could deliver.
I like the simplicity of it. Buy it 4, sell it 9:30. It's very easy to understand, and there's not any real trading other than that actually going on. So you can be agnostic on this whole question about exactly how much volatility, as long as you can demonstrate that in the long run,
Bob,
there is some outperformance.
Yeah, just to give you an idea, like in the first half of the year, it was a rough first half of the year, as you know. If you were invested 24 hours in the Russell 2, you lost about 23%. If you were just owning the night portion, again, this is not our fund, but just close to open, open to close, you were down like less than 7%.
Now say this again. What time period are we talking about?
First half of this year.
Okay, if you own the Russell 2000, you're down 23%.
23+%.
Okay.
And if you own only the night side of that, you're down less than 7. So it's pretty dramatic.
Yeah.
You know, because what you see, and what you saw in the first half of the year is many of these very volatile days where the market would just pick up steam to the downside and, you know, close on the low. And those are, you know, our research showed there was many more of these what we call left tail events, you know, during the day than there are at night. And so that's...
Left tail event being what?
A really bad down day, essentially. So one of the professors we talked to said, you know, statistically, bull markets happen in the day and the night, but statistically, bear markets happen during the day session, which is interesting. They're just much more frequent.
So the wide outperformance on the Russell would, I mean, we've seen trading volumes go through the roof in the last few years since COVID. You know, we used to do 7-8 billion shares a day at total equity trades, all exchanges, and we're doing 13 billion now, 14. A lot of this is low-priced stocks that people are trading, Russell 2000 type things. And I'm wondering if that's, you know, might be one of the phenomenon where you get people trading in after hours. You know, the Reddit crowd, it's sort of an outdated phrase, Reddit crowd, but that may be a factor here as well. I'm just trying to figure out why this happens.
I know. It's a strange thing, right? It struck me as strange when I first saw it as well, but then I really watched it, and it's just so persistent. You know, the meme stock craze is an area where you saw a huge night effect, actually, in meme stocks.
Well, there you go.
Yeah.
Yeah, because they wanted to trade after hours, right? Because the chat rooms never ended. They're always working some way or another, right?
Yeah.
Well, look, this is a fascinating discussion. I want to have you back after we had a little time to season this a little bit. Maybe have another academic on to talk a little bit about it. But thank you, guys, for being here with us. That does it for this week's ETF Edge. My thanks to Bruce and Jason. Now, we've asked Jason to stick around, give us a little more insight into his macro views for the ETF Edge podcast. That's coming up. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.